Joining us now with reaction to this morning's number and ahead of this afternoon's Fed minutes release, which will now be pretty stale, it's Krishna Guha, Evercore's vice chairman. Krishna, how problematic of a report do you think this is for the Fed?
I think it is a seriously problematic report for the Fed. The Fed, played it cool with the first bad inflation print, was measured with the second. I think they have to react more to the third bad inflation print in a row. Now, I think we need to reserve judgment a bit until we've seen PPI tomorrow, right? We shouldn't declare June cut dead just yet. Depending on where PPI prints, you could end up with a month-over-month core PCE figure that's, maybe as low as 0.26, 0.27. That would still leave June potentially in play if the rest of the data was favorable. But unless PPI helps out, June is going to slip away. And what worries me is what the Fed's plan B looks like. It's not clear to me they have a good plan B.
Isn't plan B just waiting and watching?
Right, but I think the way to think about it is this. On paper, you just go from June for 3 cuts to July for 2, and that's pretty much, mostly how the market's set up today. But the problem is, if both March and April inflation's a bit hot, and as I said, we still have to reserve some judgment there. But if that's where we're going, then in July, the 3, 6, and 12-month inflation rates are not going to look great either. And actually, they won't look great in September. And so there's a real risk here that the Fed could end up getting skittled from 3 to 2 to 1, maybe even none. My sense for the equity market is if we can get comfortable that, okay, maybe it's July for 2 rather than June for 3, I don't think that's the end of the bull market by any stretch of the imagination. But I think the market would find it harder to digest this if it looks like we're starting to slip away 3, 2, 1, maybe even none.
And Krishna, I suppose that the equity market would have a real problem digesting that if this is going to be going on for the next 6 months, mostly if there was a sense building that that it would increase the odds that the Fed stays too tight for too long. I mean, we still have the Fed's own framework saying, rates above 5.25 don't really make sense with PCE inflation under 3. They feel like they want to narrow that gap. And the longer they feel like they wait, if your eventual cut's probably going to happen on an emergency basis whenever that is.
So I think you're just spot on there, right? For the general equity market, not the AI kings or Lilly, but for the general equity market, what you need for the market to work is preemptive Fed rate cuts. Fed cutting rates for good news reasons before anything bad happens. I completely subscribe to the view that 5.25, 5.5 Fed funds is not a rate you really want to stick around at for too long. It's unlikely that that rate is going to be sustainable indefinitely without something eventually going wrong, and that's where the general market is more at risk. I have proposed that the Fed should take a step back and reframe the moves ahead in a different way. Talk about a mid-cycle adjustment in the spirit of 1994, 1995, 2019. Argue that the progress we've already made down to just under 3, say, as a run rate on core PCE inflation, and the progress that we forecast to unfold over the next few years would justify coming down, say, 50 basis points from 5.5 to the sort of high 4s, and then see what the world looks like at the beginning of next year. I worry they've become too data point dependent, chasing these latest monthly prints. We need to see the big picture plan here in a way that is robust on the inflation side, but also doesn't mean that you're doing rearview mirror policy making.